Hey everyone, welcome back to Corporate Decoder, the place where we look at company reports and try to find out if companies are actually making money or just putting on a good show. Today we're diving into Turtle Beach's financial report for the second quarter of 2025, and let's just say things are looking interesting to say the least. Before we jump in, if you're finding this breakdown useful, do us a huge favor and hit that subscribe button. Also, we've got a fantastic community on Discord discussing these filings and more, so join us there. The link is in the description. Alright, let's get straight to it. Turtle Beach put out their quarterly report, Form 10Q, for the period ending June 30th, 2025. This is essentially a checkup on how the company is doing financially between their bigger annual reports. Think of it like this. Their annual report is the full physical, and this 10Q is just a quick progress update. Now, the most important part for us is always the numbers. Let's peek at how they're making or losing money. Starting with net revenue for the 3 months ending June 30th, 2025, Turtle Beach brought in about $56.8 million. That's a pretty big drop from the same time last year when they had over $76 million last year. That's an $11.7 million. Down from over $13.2 million last year. That's an $11.6 million or about 9% decrease. It seems demand for their gaming accessories might be slowing down. Around the first 6 months of the year, they've made around $127 million or about 9% decrease. It seems demand for their gaming accessories might be slowing down. This revenue drop also hit their gross profit, which went from $23 million in the second quarter of last year down to $18.3 million this year. That's a nearly 21% drop in gross profit. Their gross margin, which is the percentage of revenue left after paying for the cost of making their products, did improve a bit. It went from 30.2% last year to 32.2% 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 last year to 30.2% last year to 32.2% last year to 32.2% last year to 32.2% this year. This is a good sign in a way, meaning they're keeping more money per dollar of sales, but it's happening because their overall sales are down. They mentioned this improvement is partly because of some one-time costs they had last year, so it looks better on paper, but the core revenue issue is still there. Then we look at operating expenses. This is all the money they spend to run the company, like marketing, research and development, and general administrative costs. For the second quarter, these costs went down to about $18.6 million from over $27 million from over $27 million last year. That's a big 32% drop in expenses. This is partly because they had a significant insurance recovery this year, essentially getting money back for a lost shipment, which reduced their expenses by almost $6 million from over $27 million from over $27 million. Without that, their expenses would have still been lower than last year, but not by as much. For the first 6 months combined, their operating expenses also decreased significantly from over $50 million last year to about $40.4 million this year. That's a nearly 20% reduction. It's worth noting that last year had quite a bit of acquisition-related costs, over $6 million, while this year it was much lower at only $6,000 or $8,000. This makes the year-over-year expense comparison a bit uneven. Because of the drop in revenue and higher expenses last year, they went from an operating loss of $4.1 million in the second quarter of last year to an operating loss of just $329,000 this year. That looks like a big improvement in operating loss. But remember that big insurance payout really helped. For the first 6 months, they actually turned an operating loss of nearly $10 million last year into a small operating profit of $1.2 million this year. This is mainly due to lower expenses across the board. When you add in interest and other expenses, their loss before taxes for the second quarter of this year was about $3.2 million, which is better than the $6.7 million loss last year. For the first 6 months, they lost about $4 million compared to a much larger loss of nearly $13 million last year. And that brings us to the bottom line, the net loss. For the second quarter of 2025, their net loss was about $2.9 million. That's a significant improvement from a loss of over $7.5 million in the same period last year. For the first 6 months, their net loss was about $3.6 million, which is much better than the $7.4 million loss they had at this time last year. Now, a quick look at shares outstanding. The basic weighted average shares outstanding dropped a bit from over 21 million last year to about 20.7 million this year for the second quarter. This is likely due to their stock repurchase programs. Let's move on to the balance sheet. Think of this as a snapshot of what the company owns and what it owes at a specific point in time. As of June 30th, 2025, Turtle Beach's total assets were about $240 million. This is down from nearly $300 million at the end of last year. The biggest changes are in their current assets. Accounts receivable, which is money owed to them by customers, dropped significantly from $93 million at the end of last year to just $36 million now. This could mean they've collected a lot of money from customers or they're just selling less. Given the revenue drop we saw earlier, it's probably a combination of both. On the flip side, their inventories, the stuff they've manufactured and ready to sell, have gone up from $71 million to over $76 million. This increase in inventory when sales are down can be a concern. It might mean they are anticipating a sales rebound, or they might be stuck with too much product. Total liabilities, what the company owes, also went down from about $178 million at the end of last year to $123 million now. This is a good sign they've reduced what they owe. Their revolving credit facility debt has decreased quite a bit, from almost $50 million to around $20 million. This means they've paid down a good chunk of their short-term debt. Their longer-term debt also saw a slight decrease, going from about $45.6 million to $40 million. This reduction in liabilities, combined with their net loss for the period, has led to a decrease in total stockholders' equity from about $120 million at the end of last year to $116 million now. It's not a huge drop, but it shows that while they are managing their debt, the company is still losing money. Now, for the cash flow statement, which shows how cash moved in and out of the company. This is a big one. For the first 6 months of 2025, they generated $37.3 million in cash from their normal business operations. This is a massive improvement from just $14.6 million in the same period last year. They attribute this to higher gross receipts, which is good, and also that insurance recovery we talked about, plus lower acquisition costs. So while sales are down, they've managed to bring in more cash through operations, which is a positive sign of improved cash management. In investing activities, they used about $496,000 for new equipment, which is a pretty low number. Last year, they used almost $80 million for investing activities, mainly for the acquisition of PDP. This year, the big investing activity was actually receiving a payment of $2.5 million related to the PDP acquisition, which they finalized in early 2025. So they're spending less on new assets and getting some money back from past deals. Financing activities show how they raise money through debt or equity and how they pay it back. This year, they used almost $41.7 million in financing activities. This was mostly paying down their revolving credit facility by quite a lot, making share repurchases and paying back their term loan. Last year, they brought in a significant amount of cash through financing around $58 million term loan for the PDP acquisition and paying back their term loan last year from taking out that $50 million term loan for the PDP acquisition. So with all this activity, their cash and cash equivalents at the end of the period are down a bit, from almost $13 million at the start of the year to $11.7 million. It's not a drastic drop, but it does mean they have less cash on hand than they did before. Okay, let's transition to some of the more detailed notes. These give us context on how these numbers came about. Remember that big PDP acquisition we talked about? This section gives us the details. On March 13th, 2024, they acquired PDP for about $114.4 million. This was a mix of cash and company stock. This acquisition was clearly a major event. It seems like a lot of the financial shifts we're seeing, like the inventory changes and the debt levels, are related to this. They really doubled down on expanding their product line and market reach with this move. This part delves into their debt situation. It looks like they've been actively paying down their revolving credit facility, which is great for reducing their short-term debt burden. They also have a term loan that will mature in March 2027. The interest rates on their debt are pretty significant, especially on the term loan. As of June 30th, 2025, the interest rate on that term loan was a whopping 12.19%. That's a very high borrowing cost and can really eat into profits. Then there's the new credit agreement signed on August 1st, 2025. This is replacing their old debt. It's structured with a $60 million term loan facility and a $90 million revolving credit facility. The interest rates on this new facility range from 2% to 3.75% plus a base rate or SOFR. This sounds like they're aiming for better interest rates with this new agreement, which will be crucial for improving their profitability. This note covers legal matters and other serious business risks. They're involved in a lawsuit in Germany. It seems Their German subsidiary, TBCH, had to pay a settlement of about €723,000 to resolve a claim related to a previous settlement. This was finalized in August 2025. It's not a massive amount in the grand scheme of things, but it's another cost they had to deal with. There are a couple of intellectual property disputes. PDP is being sued for patent infringement by a company called Nyko. It sounds like PDP is also suing Nyko to declare they are not infringing. More recently, Gamatronics filed a patent infringement lawsuit against Turtle. Lawsuits can be very expensive and unpredictable. The company acknowledges that an unfavorable outcome could materially affect their business, so this is definitely a risk to keep an eye on. This is where management essentially explains what's going on. They talk about the overall gaming market, which is huge with over 3.4 billion gamers worldwide. The gaming accessories market alone is an $11 billion business. They point to big game releases driving people to buy new gear. However, they also mention that the market demand for PC gaming accessories has seen a significant reduction. This aligns with their lower revenue numbers. They directly state that net revenue decreased, significant reduction in market demand for computer gaming accessories. This is a pretty blunt acknowledgement of the challenging environment they are operating in. Now, companies often provide adjusted EBITDA, which is a way to measure their performance by adding back certain costs like interest, taxes, depreciation, amortization, and stock-based compensation. It's an attempt to show a more stable picture of operating profitability. For the second quarter, their adjusted EBITDA was a negative $3 million last year. For the first 6 months, it's even more telling. They generated about $1 million in adjusted EBITDA this year, down from about $4.5 million last year. This adjusted figure, even after removing many expenses, still shows a decline. Let's talk about liquidity. This is how much cash they have easily available to keep the business running. We saw that cash from operations was strong $33 million for the first 6 months, up from $14.6 million last year. This is a solid positive, but their actual cash on hand, as we saw, dipped to $11.7 million. While they have access to their revolving credit facility to get more cash if needed, this lower cash balance is something to watch. The new credit agreement they put in place in August 2025 seems designed to give them more flexibility and potentially better borrowing terms going forward. This is a strategic move to manage their debt and ensure they have the funds needed for operations and future growth. Under controls and procedures, they state that their disclosure controls and procedures were ineffective as of June 30, 2025. This is a red flag. It means that the systems they have in place to ensure all important information is properly reported might not be working perfectly. They are working on fixing this. Here they highlight a few key risks. Dependency on gaming platforms and new game releases is a big one. If Microsoft, Sony, or Nintendo don't do well, or if big game releases are delayed, it hurts Turtle Beach. They also mention trade policies and tariffs, which could increase costs and reduce demand. And those intellectual property disputes we saw earlier are also listed as a significant risk. Overall, Turtle Beach is navigating a tough market. Sales are down, which is concerning. However, they've done a good job of reducing their debt and managing their operating expenses, especially by bringing down acquisition-related costs. The improved cash flow from operations is also a positive sign. The new credit agreement could help them manage their finances better moving forward. The key challenges are the slowdown in PC gaming accessory demand and the ongoing legal battles. Looking at the financials, the reduced debt is good, and the improved gross margin is a small win amidst lower sales. But the drop in overall revenue and the adjusted EBITDA figures the core business is struggling to grow in the current environment. The ineffective disclosure controls are also a concern that needs immediate attention. What's my take? Turtle Beach seems to be in a bit of a turnaround phase. They've made some strategic moves like the PDP acquisition, and they are cutting costs and paying down debt. The success of these strategies really hinges on whether the gaming market rebounds, especially for PC accessories, and if they can stay out of costly legal battles. For now, it's a mixed bag, some signs of operational improvement, but significant headwinds from market demand. Alright, that's our deep dive into Turtle Beach's latest financial report. What do you think about these numbers and the company's direction? Let us know in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more. And don't forget to join our Discord community for continued discussion. Thanks for watching, and we'll see you in the next one.